Have you ever dreamt of achieving financial freedom? Imagine a life where your money works for you. This is the allure of the stock market, a world of opportunity. But success requires knowledge, discipline, and understanding. With the right guidance, anyone can master stock investing. Before diving headfirst into the world of stock investing, it's crucial to establish a solid foundation of understanding. What exactly are stocks, and how do they represent ownership in a company? We'll answer these fundamental questions, providing you with a clear understanding of what it means to be a shareholder. Next, we'll explore the dynamics of the stock market, introducing you to key concepts like stock exchanges, such as the NYSE and NASDAQ, and how stock prices are determined. Understanding these fundamental principles will give you a better grasp of the forces that drive market movements. A stock signifies ownership in a publicly traded company. Think of a company like a giant pizza, divided into slices. Each slice represents a share of stock. Buying shares makes you a part owner of the business. It grants you voting rights on company decisions and a portion of the company's profits as dividends. When you buy shares of a company's stock, you're essentially betting on its future success. If the company performs well, its value is likely to increase, and the price of its shares will rise accordingly. This increase in share price translates into capital appreciation, allowing you to sell your shares for a profit. Conversely, if the company faces challenges or its performance falters, the price of its shares may decline. This potential for both gains and losses is inherent in stock market investing, highlighting the importance of thorough research, diversification, and risk management strategies. Section 3, Beyond Numbers, Stocks as Building Blocks. Stocks serve as the building blocks of a diversified investment portfolio, offering the potential for growth and wealth creation. By investing in a variety of stocks across different sectors and industries, investors can mitigate risk and capitalize on the growth of the overall economy. Furthermore, stocks provide a hedge against inflation, as their value tends to increase over time, outpacing the rate of inflation. This makes stocks an attractive option for long-term investors seeking to preserve and grow their purchasing power. The heart of trading. Stock exchanges. Stock exchanges are virtual marketplaces for buying and selling stocks. They allow companies to list shares publicly and connect buyers and sellers, establishing rules to maintain market integrity and transparency, crucial for liquidity and capital formation in the global financial system. Section 2, the price tag of ownership, valuing a stock. Determining the value of a stock is both an art and a science. Numerous factors influence a stock's price, including the company's financial performance, industry trends, economic conditions, and investor sentiment. Analysts employ various valuation methods to assess a stock's worth. One common approach is fundamental analysis, which involves scrutinizing a company's financial statements, such as its balance sheet, income statement, and cash flow statement. By analyzing these documents, investors can gain insights into a company's profitability, revenue growth, debt levels, and overall financial health. Section 3. Navigating the exchange landscape, NYSE versus NASDAQ. While numerous stock exchanges operate globally, two of the most prominent in the United States are the New York Stock Exchange, or NYSE, and the NASDAQ stock market, often simply called NASDAQ. Each exchange has its unique characteristics and listing requirements, attracting different types of companies. The NYSE, established in 1792, is the world's largest stock exchange by market capitalization, representing the total value of all listed companies. Known for its traditional auction market structure, the NYSE relies on designated market makers or specialists to facilitate trading and maintain orderly markets. Section 1. The buy low, sell high strategy. Capital appreciation. Profit from stock investing through capital appreciation. Buy low, sell high. Purchase stocks at a lower price, sell at a higher price. The profit represents capital appreciation. Identify undervalued companies, buy shares at a discount, sell when value increases. Section 2. Sharing in success. The power of dividends. Dividends offer another avenue for profiting from your stock investments. When a company generates a profit, it may choose to distribute a portion of those earnings to its shareholders in the form of dividends. These payments typically occur quarterly and are paid out on a per-share basis. Think of dividends as a thank you gift from the company for being a shareholder. As a partial owner, you're entitled to share in the company's success, and dividends provide a tangible way to participate in those profits. Section 3. Two paths to profit. Combining capital gains and dividends. Investors seeking to maximize their returns often aim to combine both capital appreciation and dividends in their investment strategies. This dual approach allows them to benefit from both the potential for stock price growth and the steady income stream generated by dividends. Imagine a company whose stock price increases steadily over time while also consistently paying dividends. Investors holding this stock would experience the best of both worlds, enjoying capital appreciation as the stock's value rises and receiving regular dividend payments. Section 1. Setting the stage, financial goals and risk appetite. Before diving into stock investing, lay a solid foundation. Define your financial goals. What are you hoping to achieve? Saving for retirement, a house, or education? Clear goals guide your investments. It's like having a destination before a journey. Section 2. Knowledge is power. Learning the stock market ropes. The stock market can seem intimidating at first, but like any new endeavor, education is key. Take the time to learn the basics of stock investing, familiarizing yourself with key concepts, terminology, and market dynamics. Fortunately, a wealth of resources is available to help you expand your knowledge. Books, online courses, financial websites, and even podcasts cater to investors of all levels, from beginners to seasoned pros. Remember, knowledge is power, and the more you understand about the stock market, the better equipped you'll be to make informed investment decisions. Section 3. Choosing your path. Active versus passive investing. You have two primary paths: active investing and passive investing. Active investing involves frequent buying and selling of stocks. Active investors spend time researching stocks and timing trades. Passive investing takes a more hands-off approach. Passive investors aim to match the market's performance. They invest in index funds or ETFs, tracking market indices like the S&P 500. Section 4. Taking the leap. Opening a brokerage account. Once you've set your financial goals and assessed your risk tolerance, it's time to open a brokerage account. A brokerage account is your gateway to the stock market, allowing you to buy and sell investments. Consider factors like trading commissions, account minimums, and customer support. The power of patience. Long-term investing. Patience is not just a virtue, it's a powerful strategy. Holding stocks for years benefits from compounding returns. Like a snowball, consistent growth leads to significant wealth. Long-term investors ride out market fluctuations. Section 2. Building wealth with dividends. Dividend investing. Dividend investing focuses on generating a steady stream of income from your stock portfolio by investing in companies that consistently pay dividends to their shareholders. These regular payments can provide a source of passive income which can be used to supplement your living expenses, reinvest in your portfolio, or achieve your financial goals. Dividend-paying companies are often well-established businesses with a history of profitability and a commitment to returning value to their shareholders. They tend to operate in stable industries with predictable cash flows, making them attractive options for income-oriented investors seeking consistent returns. Diversification and risk mitigation. Stock investing inherently involves risk. Market fluctuations and unforeseen events can impact stock prices. Implementing prudent risk management techniques can protect your investments. Diversification is an effective strategy. Don't put all your eggs in one basket. Spread your risk by investing in a variety of assets. Section 2. Mastering your emotions. Disciplined decision making. While diversification and stop-loss orders provide a safety net for your investments, perhaps the most critical risk management tool is your own behavior. Emotional decision making, driven by fear or greed, can lead to costly mistakes in the stock market. When the market is soaring, it's easy to get caught up in the euphoria and make impulsive decisions, buying high out of fear of missing out. Conversely, when the market takes a downturn, fear can set in, prompting investors to sell low, locking in losses, and missing out on potential rebounds. The prudent investor's path: discipline, knowledge, and long-term vision. Success in stock investing hinges on informed and disciplined decision-making. Quick riches can be tempting, but the true path to wealth is long-term. Focus on knowledge, patience, and sound investment choices. The stock market is a mechanism for owning businesses and sharing in their profits.